Thanks for having me.
You say all the moves this week are sort of a bull market trap. What are the charts telling you, and walk us through it?
Sure. I mean, the primary view on this NASDAQ 100 chart is if you look at the moving averages, the 50-day, the 100-day, 200-day, all three of them are rising with the shorter-term moving average above the longer-term moving average. So what that tells us is we're in an uptrend. But yesterday was significant. We gapped down on the S&P, and we formed what we would call a bull trap on the market. What that means is we gapped up on the 9th of March. We gapped down on the 19th, or yesterday. We had 6 days of price action above those gaps where we trapped the bulls on this breakout. So we have right here a failed breakout and a bear trap with an island reversal. So the bears, a bull trap. So the bulls are trapped in this island up here. They become a natural source of selling pressure on rallies. And what you could see is a dip down in towards these moving averages. Or we could retest that low that occurred in early March, roughly around the 66.40 level, and maybe even test that rising 100-day moving average, which comes in just below the 6,600. But even if we start breaking those lows, you could even revisit the 200-day. Again, all this, given the moving averages, is within the context of a larger uptrend at this point. That hasn't changed. It's just the market has gotten choppy near term, and we have a failed breakout that we have to digest for the near term, and we could retest that 6,600, maybe 6,200 range on the NASDAQ 100 before it's all said and done. Let's move on to the S&P 500. What's notable about this chart is the same trend. The 50 days above the 100, 100 above the 200, so we're in an uptrend. But the notable difference is it was just tech that went to new highs, nothing else followed. So other sectors did not follow the leadership of tech. Have the same exact 6-day island reversal on the S&P 500. And what this suggests to us is that we can go down and test this low at 2645 and maybe even exceed it and move back down towards the 2300 range. I'm sorry, not 2300, 2600 range to maybe even retest that low at 2532. It's possible. What we need to change this view on the tactical perspective is really just to get back beyond that 2750 to 2800 range on the S&P 500. And while you're below that area, that bull trap is intact, the 6-day island's intact, and the risk is near term we correct a little bit further. What we may need to see to suggest that there's enough fear in the market to get the bulls refreshed is that VXV to VIX ratio. What was very, very interesting about this ratio is if you take a look at it, we actually hit the lowest level going back to August 2015, back in early February. And a lot of times these markets, you can see right here, you had more of a retracement, You went back and moved below that 1 level again, which would indicate fear. So when the VXV to VIX goes below 1, the level indicates elevated fear in the market. We may need to see that again on this, meaning that this does need to go back down. Maybe does not go quite as low as it was in February to say, hey, the bulls are back. We're oversold enough to get that good rally in the market.
All right, both my traders want in. Jim, let's go ahead and start with you.
First of all, you talked about the broader market still being an uptrend, and I agree. So that means to me, implicitly, that this is a garden variety correction. Corrections have to be not only a component of price, but a component of time. When you look at these charts, what's your guess for how long this resolution process takes before the bulls come back in charge?
I mean, that's a great question. I mean, it could be a while. I mean, it could be another month or two. We could get that rally into, actually it could happen actually into late April. When you think about it, seasonality in April is actually quite bullish. And then you get into that more bearish period between the May and October time frame, which this is a midterm election year. And oftentimes you do get some volatility during that period. So I think it could be with us into maybe another month or so, and then you get another rally attempt, and maybe you do get to new highs. And they actually could be a little bit short-lived, though, if you're thinking about seasonality and also midterm election year patterns. So, you know, it's going to be a bumpy year, I think, based on that, but within the context of a larger secular bull market trend.
Okay, Jeff?
Got it.
Well, look, obviously tech has been just a love affair. We kind of have a broken heart here. You talking about tech falling out of love. So what is that level? Because the Nasdaq's provided leadership in all of 2017 as well as 2018. What percent down do we have to see in the Nasdaq for the almost 10-year bull market to be over?
We're blowing some froth off that cappuccino that tech has seen. Thank you.
Fair enough.
This is the so basically this high right here, which seems to be acting as a support so far. So that's what we're thinking on that group.
All right, Stephen, great to see you. Thanks for bringing the charts along.
Yep, thank you.
We'll see you again soon. Meantime, Jim, out of that interview, you're going to trade the S&P for us. Do you agree with him? The uptrend is intact, even though there could be some choppiness?
I certainly believe that the broad uptrend is intact, and I believe they're going to trade back and forth for a few more weeks. So he and I are completely on the same page. I said before that the market seemed to lack momentum, and I stand by that, despite the fact that I think if we can trade about 4 ticks higher in the S&P, 27, 24, on the very short term, I think that'll be a boost higher. And I think that's a spot to stop yourself in with a target of 27.44 on the upside and a stop place below 27.11. Now, a caveat here, if we get that 24 trade and ahead, no, this is called trading, I think. It's futures now. If we get that 24 trade and get a couple ticks into it, you probably ought to be moving your stop up, and we're going to manage this trade on Twitter if it works out.
I don't mind this, Jackie, from the way he's getting into it. It's a stop-in technique. We love talking about stop-in techniques, either to buy or sell. But this is HE double hockey sticks. No, we have a Fed day. We're in no man's land right now. We just saw the technical damage overnight. We went under 2,700 in the S&P 500. I think we back and fill there before we see that prejudice or that rhetoric come out of new Chair Powell.
Wow, that was a very passionate hell no on this trade, for the record.
Very passionate. I don't even know what to say.
Yeah, he's speechless.
Well, let's go ahead and get the risk reward before we move on, guys. Jim is buying the April contract, 27.24. He's targeting a move up to 27.44. Each point is $50. He's risking 650 to make 1,000 in this trade.
Hi, everyone. I'm not sure if you noticed, but at the end of this trade walkthrough, they were talking about a hockey stick pattern. If you're curious to find out more about patterns and how to trade them and which patterns are more predictive of the next market move than the others, visit marketcrash.money. Find some information why market crash in 2018 could be a definite possibility, why we could be facing another Bitcoin crash. Click right here, how to profit, so you can protect yourself and take advantage of the stock market crash before it takes advantage of you. If you're a brand new trader trying to learn how to trade stock, options, futures, or a veteran trader looking for new ideas and new strategies, click right here on how to profit, schedule your consultation, and find out how to profit from the next market move. Thanks for watching. I'll see you in the next video.